Hi everyone, my name is Azlin Ahmed and I am VP of Business Development for Crude here at Argus. The oil markets have been in turmoil since early March, and now the US and Iran have taken a big step towards de-escalation. The two presidents have signed a memorandum of understanding, which is essentially a starting point. It doesn't solve everything yet, but it kicks off a 60-day window where both sides will try to hammer out a full agreement, mainly around Iran's nuclear programming and some other sticking points. Still, the market reaction was immediate. Oil prices have fallen, with the market already pricing in the prospect of returning stability. A big part of this deal revolves around the Strait of Hormuz, which, as we know, is critical for global oil flows. Iran is committing to get vessel traffic back to pre-war levels within 30 days. That means clearing mines, fixing technical issues, the whole lot. They're also promising to let ships pass through for free for 60 days, which is notable because there had been talk about charging transit fees. Traffic is supposed to resume almost immediately, and Iran and Oman will start working out a longer-term framework on how the strait is managed going forward. On the other side, the US is offering major concessions, most notably lifting sanctions, although that will be phased and tied to Iran sticking to its nuclear commitments. The US and its regional partners are also talking about putting together at least $300 billion to support Iran's economic recovery and development. That's a massive number, and it shows how far Washington is willing to go to stabilize the region and secure energy flows. Now, President Trump, for his part, has been quite direct, saying that the priority is reopening Hormuz and that military options have run their course. At the same time, he's still keeping some pressure on and have hinted at possible tolls on ships and even warning that military action could resume if Iran doesn't rein in groups like Hezbollah. Now, even with the agreement in place, it's not all smooth sailing, literally. The weekend the MOU was signed, vessel traffic through the Hormuz slowed, which suggests there's still uncertainty or at least hesitation in the market. Some ships turned back, others switched off their tracking systems, and overall movements point to caution rather than full confidence. Part of the confusion comes from the mixed signals. Tehran at some point said it would block vessel movement, partly blaming continued Israeli strikes on Lebanon as a violation of the agreement. Meanwhile, Washington has insisted that commercial shipping was still flowing relatively normally. The conflicting narratives probably weighed on shipping activity. But from a market perspective, the potential reopening of Hormuz means possible return of around 12 million barrels per day of crude exports that were effectively stranded. Some shipments have already started moving again, and Middle East producers, Saudi Arabia, the UAE, Kuwait, are already gearing up to increase exports. Prices are under pressure, and benchmarks like Dubai crude have now slipped into a contango. If US sanctions on Iran are eased, that introduces another major source of supply back into the market, although most buyers, particularly in Asia, have remained cautious because of other sanctions and financing complications. Reopening of the Strait of Hormuz restores a route that normally carries about 20% of global oil flows, but it takes time to clear shipping backlogs and restart flows. Damage from the war can also slow the ramp-up in Mideast crude production, and any signs of tensions returning can quickly push prices back up. If the deal holds, the bigger structural impact kicks in. Sanctions relief allows Iran to sell more crude globally. Middle East producers can move more barrels once Hormuz normalizes, and some analysts are now already talking about a potential surplus scenario. With physical constraints such as demining, congestion, and selective vessel movements, how will the market model the actual pace of supply returning via Hormuz? And what leading indicators will confirm when flows are truly back to pre-war levels rather than just headline-driven optimism? As potentially stranded Gulf and Iranian barrels re-enter the market into a backdrop of steel-depleted global inventories, should we expect a sustained glut or a more balanced market? And how will this tension shape the forward curve and refining economics? To what extent is the price correction driven by the assumption of a stable deal? And what geopolitical or operational triggers could cause the price premium to reprice sharply higher again? These questions and more will be discussed by experts at the Argus Oil Forum, and we hope to see you there.